how your thinking has evolved given what we've witnessed just in the last couple of weeks in markets, because it feels as though a lot of that inflationary theme, a lot of the reflationary narrative has played out. You're seeing a big rally back in bonds again. You're seeing cyclicals and value stocks underperform versus growth stocks. So where does that leave your new nominal hypothesis?
Well, thank you very much for inviting me. I mean, I think we obviously still very much believe in the new nominal, but I think, what you were describing just before we got to me on the show was this idea that there is a really broad range of outcomes, right, where we are at the crisis and at the recovery and the reopening. And so markets are going to move from one scenario to another. And I think what we've seen here, obviously, is that the reflation trade, which was obviously very much in favor in the spring, has moved aside. And I think that would explain, in many respects, the flattening of the yield curve, lower yields. But we still very much believe in this idea of the new nominal. And that's really based on the idea that the economic restart is real, right? And that we are seeing that expand into countries outside of the first movers in terms of vaccination and reopening. And that's going to really be a very important kind of fundamental positive. And against the backdrop, we do expect, and it's part of the new Fed framework, for policymakers to be slower to react to that increase in inflation, which we don't view as being, a spike huge higher in inflation. But as inflation increases, central bankers are going to be slower to react, and thus rates will stay relatively stable. Real rates will stay relatively low. That is the new nominal, and in our mind, that's still very much the environment that we're in. It's our major investment theme for the rest of the year and beyond. And in the environment, we still think that's valid.
Well, you talked about the flattening of the yield curve, and looking at US 2s10s, we've flattened about 40, 50 basis points since the highs back in April, May. I just wonder whether you're looking at this as an opportunity to fade, especially given so many market participants have brought forward the timing of the first rate hike. In your view, is that overblown now?
Yeah, I mean, what we would say is in our outlook, we have moved to a further underweight to U.S. Treasuries on the view that valuations to us, and I think the yield direction and the curve direction, that is, yields have been falling and the curve has been flattening, are very much the same signal, which is that, in our mind, the market is perhaps getting a little bit too excited about the prospect for rates to remain as low as they are, and so we've moved to, on a valuation framework, move to a more negative view around U.S. Treasuries. Again, noting that the yield curve flattening and yields falling has been one and the same.